We are joined once again by Allan Small, Senior Investment Advisor at the Allan Small Financial Group, IA Private Wealth. Great to see you again, and thanks for sticking with us, Allan.
My pleasure.
Off the top, talk about this U.S.-China squabble right now. They don't actually have a trade agreement, but they agreed to a standstill, but both sides say they're violating it.
Yeah, it's interesting. You know, they're talking about obviously pausing the, whatever it was, 145% tariffs, outrageous, basically an embargo. And now they're bringing it down, I guess, to, 35%, which is 25% fentanyl, plus another 10%, which is the base case for everybody. And they're both now, I guess, not happy. One is not sending chips to China. China is now holding back rare earth materials or elements, or that's, I guess, what they're talking about. And so the market woke up this morning in a bit of a bad mood because the two dominant countries in the world today are once again going at each other. But I think everything kind of calmed down because we're seeing, obviously, the NASDAQ higher right now. Tech started to move higher because there was an announcement out of someone in the White House saying that President Xi and President Trump will be speaking, I guess, in the coming days. So everything just turned on a dime, as it always seems to. Whenever things are going too bad, something positive comes out and vice versa. A very volatile market, but obviously the trade negotiation between those two countries, if one could get done and if they could hold, would go a long, long way for the stock market. You could see massive gains, I believe, on the U.S. side, and that would obviously spill over to us here in Canada. It would just be the biggest and most important agreement in terms of stock market performance in the U.S., as I said, and our market, as we know, tends to follow the U.S., and so I think it would be a fantastic day for investors if something were to happen.
Although it could take years to announce a deal because it's so complicated.
It would be. But I think as you hear more and more of the detail, it doesn't have to be, pen to paper tomorrow. But as long as they get a framework and then they continue to work on that framework, I think that would be just a massive win for investors.
You have spent quite a while watching the bond market, much of your career, and Jamie Dimon, he said this before apparently, but he was talking to Fox Business Network. He said the worsening debt situation, government debt situation in the US is a big deal and a real problem, and the bond markets are going to have a tough time at some point.
Yeah, we're seeing it now, right? We're seeing in the US 30-year above 5%, the 10-year, I think it touched over 4.6. Obviously, the Fed can control to some degree or on a regular basis the short-term bond rates. Longer term tend to move with the markets. It's interesting. One thing I come back to was this idea of trade negotiations. And the president saying he wants to, a lot of the trade deficits that the U.S. has with other countries, the surplus other countries have with the United States, and he wants to get rid of that. Well, obviously, yes, Japan, for example, has a trade surplus with the United States. But then they take that surplus and go out and buy government treasuries, U.S. government treasuries. Yeah. So if you get rid of that surplus with a country like Japan, what are they going to use to go out and buy U.S. debt? And so that's going to be a problem. And we've already heard Japan, I think, selling off a bunch of U.S. debt. And, Japan, coincidentally, has probably the only country that has more debt than the U.S. So the more debt that keeps piling on, obviously, the more we're going to see U.S. bonds go higher. We just saw the U.S. lose their AAA status, I guess, on the last rating agency. It is a problem. And I think now they're up over $1 trillion in interest payments alone. And that's scary. So something's got to happen. Something's got to change. I think the president currently is trying to change it, just not sure his methods are the best way. Dimon says,
he says America should take growth measures and adopt pro-business policies. Well, I guess they have been with Trump deregulating whenever he can.
Absolutely. And I guess the talk is that if they can grow their economy above 3% consistently over a prolonged period of time, then that could help bring down the deficit over time. But they need to get it up to a 3% number. That's the number I've seen. And right now, well, I guess last quarter they were negative. Prior to that, end of last year, they were coming to 2.5. But right now, the last quarter wasn't too great. We'll see what quarter number 2 brings in.
Are your clients attracted by, speaking of fixed income, are your clients attracted by GIC rates in Canada right now?
Not really, no. 2%, 3%. I think recently just over 3% GIC rates. The whole thing about GICs is that, yes, the interest rate is low, but for the most part, you're locked in, right? You do have cashable GICs, but for the most part, you're locked into that rate. And for those that panicked, sold out of the market back earlier this year, moved into GICs, well, they've missed a pretty big run over the last month or so. So GICs just doesn't cut it for many investors right now. I would almost imply that the acronym TINA is starting to apply once again. There is no alternative to the markets, especially if you're looking for a growth rate and at least in that 5 to 10% range.
Yeah, you can. EQ Bank seems to be pretty aggressive right now on the GICs. They're offering apparently 3.85% on a 5-year, but there may be some terms attached to that.
I would say the 1 year probably be a little lower than that.
It is lower, yeah.
So you're looking maybe 3.5 on a 1 year.
Yeah.
Just not enough. You got to pay, tax on the whole thing.
Yeah.
Plus, inflation is growing at 2.5 or so, 2.5. So pretty much of that gets eaten up by taxes and inflation. You're left with not a whole lot.
Sometimes I wonder, should I just put my whole portfolio into Canadian dividend stocks across the utilities, banks, telcos, pipelines?
I think if you had done that, it would be obviously a winner. Especially you're looking at, Scotiabank 6% dividend, Emera 4 or 5% dividend. You're looking at Enbridge 6% dividend. There are a lot of names that have shown good growth and a good dividend over many years. So definitely an opportunity for investors.
I mean, if you own, say, 20, which is probably too many, I mean, some might cut, but generally you should be okay.
I think you should be okay. Canadian banks have never cut. You throw in a couple of big cap tech names plus your dividend pairs, and there's your diversified portfolio.
We better take a break. Allan, thanks very much. Allan Small Financial Group of the Allan Small Financial Group, IA Private Wealth. Coming up.